Welcome back to Investing Talk Podcast.
Today we're looking at stock.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For this company, the story isn't really about explosive growth, at least not yet.
Right.
The whole narrative here is defined by this really significant, hard-fought turnaround. It's about financial stabilization in a sector that has been, frankly, incredibly punishing.
Okay, let's unpack this, because the core context is the industry itself, and that backdrop is, well, it's brutal right now.
Oh, absolutely. We've seen capital just dry up, intense saturation.
And when we look at many of their public peers in that same space, they've been reporting deep revenue declines.
Yeah, we're talking 8 to 10% year-over-year contraction, pretty much across the board.
The whole category has just been facing massive headwinds.
It has. And what's so fascinating here is how stock manages to completely contrast with that negative pull. Well, management is guiding for essentially flat net sales for the full fiscal year 2025. They're projecting, around 19.1 to 19.3 million.
Compared to what, 19.5 million last year?
Exactly. And if you just look at that number in isolation, flat revenue is not exciting at all.
Right, but you have to look at it relative to the market.
That's the key. When your main competitors are shrinking by 8 or 10%, achieving flat revenue means you are actively gaining market share.
That's a powerful shift.
It signals this major underlying resilience in their brand and, their distribution channels. They've basically gone on the offensive just by holding their ground.
So where's the first concrete proof that this resilience is actually turning into, observable growth? Flat is good, but investors want to see a forward look.
And that proof is, it's embedded right there in the Q4 projections. They're forecasting Q4 net sales growth of plus 3 to 5% year over year.
Okay, so that's the first real green shoot.
It is. That small, clear increase is the first quarter of solid year-over-year growth we've seen. It's a validation that their whole strategic pivot is actually starting to pay off.
Which brings us to, I think, the most critical part of this whole turnaround story, the earnings inflection. You can stabilize revenue all day, but if you're just bleeding cash, it doesn't really matter.
And this is where the core market optimism is coming from. It's driven entirely by aggressive, disciplined cost control.
So what are the numbers?
The full year fiscal 2025 net loss is expected to be nearly halved. They're improving from a $3.7 million loss in FY24 down to a projected loss of about 1.9 to 2.1 million.
Wow. That's not just cutting a few corners.
No, this suggests really deep structural changes. They rebuilt their operational machine to be lean.
Let's talk viability, though. I saw they have a gross margin that's incredibly high, something like 61%.
61.2, yeah.
That tells you the business model is actually viable at the product level. They're selling things people want at a good margin.
Absolutely. That high margin is the foundation for everything else. You contrast that with the narrowing net loss and a barely positive EBITDA margin. It's about 0.4%.
But hold on, if their EBITDA is only 0.4%, isn't that still razor thin? Couldn't one bad quarter just wipe that out?
That's a great question, and it's why you have to look at both. The positive EBITDA, even if it's small, tells us the core operations are healthy. They're covering their basic fixed costs.
So they're basically at operating break even.
They are. The small net loss that's left is now mostly driven by non-cash charges or debt service. It means the underlying business is far healthier than that headline number suggests.
Okay, so if we connect the cost-cutting and the high margin to the future, what does that mean for an investor?
Well, this sets up what analysts love to call an asymmetric operating leverage setup.
Okay, jargon alert. Let's translate that.
Right. So to put it simply, because their gross margins are so high and their fixed costs are already covered.
That near zero EBITDA.
Exactly. It means that even modest future revenue increases could flip the entire financial profile dramatically.
So $1 of new revenue isn't just bringing 60 cents to the gross profit line. It's bringing almost the whole dollar straight to the bottom line.
Precisely. The leverage here means that a growth rate of even 5 or 10%, which seems achievable, could flip the company from a net loss to GAAP break even or even positive EPS in the next, say, 4 to 6 quarters.
And that's what gets you to positive free cash flow.
That's the whole aim.
Okay, now let's pivot from the operational side to the structural, because this is where it gets really interesting, especially on risk. They had a huge win recently by regaining NYSE American compliance.
Huge is the right word. It might sound like paperwork, but it's absolutely critical for the company's lifespan.
It resolves the single biggest risk factor, right? The possibility of being delisted.
It does. Being delisted to the OTC formats was a huge overhang, and regaining that NYSE listing, it required serious financial maneuvering, converting preferred shares, a capital raise. They really had to clean up the balance sheet.
So why does staying on the NYSE matter so much to the everyday investor?
Two massive reasons. First, institutional capital. A lot of mutual funds, hedge funds, they just can't own OTC stocks. So this keeps stock in their universe of investable companies.
For a second.
Liquidity and transparency. The listing itself provides a level of rigor that just dramatically reduces the risk premium on the stock. It took that existential threat right off the table.
That compliance win also ties directly into their competitive moat, doesn't it?
It really does. I mean, they're already one of the most recognized CBD brands in the U.S.
And they have a really comprehensive product line, including those Farm Bill-compliant Delta 9 offerings, which are a big deal right now.
Exactly. And in this fragmented, often gray market industry, compliance and brand are your biggest barriers to entry.
Because in a world where every corner store seems to sell some kind of CBD, brand trust is everything.
It is. The industry is a regulatory minefield, and consumers are skeptical. Stock leverages its known brand and its major exchange compliance as this powerful barrier. They can consolidate market share as weaker, less compliant. Players just fail.
So they're using their survival as a weapon.
That's a perfect way to put it, and it dictates their capital allocation. Management is very clear about building a durable, long-term business.
Which means don't expect dividends or buybacks anytime soon.
No, not at all. Their priority is balance sheet repair and then very targeted, high ROI brand reinvestment. They're playing the long game.
Now let's talk about the market's reaction because it has clearly taken notice. The price action was explosive.
It was a violent upside re-rating. Following the news about the financials and the NYSE compliance, the stock surged between 55% and 90% in a single day.
That's not a slow drift.
Not at all. It was a decisive breakout from a deeply depressed base. The market almost instantly re-underwrote the risk profile of this company. The narrative just flipped from can they survive to when will they be profitable.
And for anyone who tracks charts, that price action gives us a really clear technical reference point. That pre-spike consolidation range around 60 to 65 cents.
That's now your key technical support band. That range is a new psychological anchor. And the fact that the price broke so decisively above its moving averages, it really sets up a potential trend reversal.
And the most immediate kind of binary catalyst is looming right in front of us.
The full FY25 earnings report.
Yeah.
That's projected for mid-December. This event is absolutely crucial.
Management has to step up and reinforce this new bullish narrative.
They have to. They need to confirm the strong preliminary figures and, most importantly, provide convincing guidance for 2026. If they can confidently project a path to consistent profitability, the current valuation could look inexpensive very, very quickly.
And then beyond the company-specific news, you've got those speculative tailwinds that can move the entire sector.
For sure. This stock is positioned as a highly leveraged play on any sector-wide policy shifts.
You mean like federal reform?
Federal marijuana reform, rescheduling announcements, even just softening state regulations. Any major change in that landscape could send the entire sector soaring, and stock is perfectly positioned to capture that upside.
Okay, we've covered a lot of the optimism here, but we have to talk about the bear case. This is still a micro-cap turnaround. There are massive risks baked in.
Let's start with the most fundamental one. The company is still loss-making. They are still generating negative free cash flow.
So their success relies entirely on continued perfect execution.
Exactly. If that revenue stabilization fails, if Q4 was a fluke or the market gets worse, future dilution from capital raises is a very real possibility.
And then there are those external pressures. The CBD and hemp market is still a regulatory minefield.
It really is. The FDA could issue new restrictive guidance tomorrow. State legislatures are constantly battling over these things. The turnaround depends on them executing flawlessly against these relentless headwinds.
It's not just running a business, it's a constant regulatory battle.
Right. And finally, just a word of caution on liquidity. This is a micro-cap stock with extreme volatility.
That 90% single-day move proves it.
It's a perfect demonstration. This increases execution risk. You have to be prepared for violent swings. While that volatility provides the potential for that asymmetric upside, it also means stop losses can get triggered easily.
So the central theme here is pretty clear. Stock has shown remarkable resilience. They've stabilized revenue and halved losses when most competitors are just faltering.
It's the definition of a high-risk, high-reward turnaround story. It's anchored by an established brand and those structural cost improvements.
And they addressed the major solvency risk by regaining that NYSE compliance. They're no longer facing an existential threat.
Right. So now the market is watching. We're all watching to see if this new cost discipline converts into sustained profitability over the next 12 to 18 months.
Yeah.
It's a classic leveraged turnaround play.
The real question for me, for the long-term investor, isn't just whether they hit break-even. It's whether they can leverage that brand and their compliance to maybe acquire a failing competitor. If they can start consolidating this fragmented market, that could turn the story from linear to exponential. That's the real game changer. If you want to keep up with the latest insights on companies approaching that crucial inflection point, make sure you hit that subscribe button.